Hey everyone, and welcome. Have you ever wondered what really makes a company tick? Or maybe more importantly, what stops it from completely flying off the rails? It's not just about having a killer product. It's about the rule book, the constitution that holds the whole thing together. And today, we're going to dive deep into exactly that, corporate governance theory.
So, here's our game plan. We'll kick things off with a few cautionary tales. What happens when things go wrong? Then, we'll build up the solution, defining what a corporate constitution actually is, looking at the 4 pillars that build trust, and figuring out who's really in charge. After that, we'll connect the dots to see why this stuff matters to the bottom line, and finally, peek into the future of governance. All right, so let's start with a bit of a corporate horror story. You see these massive, seemingly untouchable companies, and then, poof, they vanish almost overnight. And what's wild is that they often share the same fatal flaw, one that's usually hidden from view until it's way too late. So I want you to think for a second. Think about some of the biggest, most infamous corporate scandals in recent memory. You've definitely heard their names, and almost certainly for all the wrong reasons. What's the one thing that connects their spectacular failures?
Yeah, I'm talking about names like Enron, the energy trading giant that basically invented new ways to lie on a balance sheet, or WorldCom, the telecom behemoth that just decided to hide billions in expenses to make their profits look amazing. And more recently, Carillion, a huge UK construction firm that just crumbled under a mountain of debt it wasn't telling anyone about. Titans of industry, right? All brought down by a complete and utter breakdown of trust.
And that's the answer. This wasn't just a bad product launch or a tough quarter. The real problem, the root cause, was that their internal rulebook, their system of checks and balances, was an absolute mess. The oversight was gone, the ethics were questionable, and accountability was just not there. And that didn't just hurt shareholders, it cost thousands of people their jobs.
Okay, so that catastrophe brings us to the solution. If having a weak rulebook leads to total disaster, then what does a strong one actually look like? This is where we get into the idea of a corporate constitution.
At its core, corporate governance is really just the framework that keeps a company running properly. Think of it like this. It's all about creating a healthy balance of power between the people who own the company, that's the shareholders, the people who oversee it, which is the board of directors, and the people who run it day to day, aka the management. It's the system that makes sure everyone is playing their part.
And let's be clear, this isn't just about creating a bunch of boring rules for the sake of it. The whole point, the ultimate goal, is to make sure the company makes smart decisions, that it behaves ethically, that it's open and honest about what it's doing, and, this is the big one, that it creates real, sustainable value over the long haul. Now, to make all that happen, good governance has to be built on a really solid foundation. You can kind of think of it like a building. It needs 4 essential pillars to hold up the entire structure and make sure the company is trustworthy. Okay, so first up is accountability. This just means the people in charge have to be answerable for their decisions. Simple as that. Second, you've got transparency. No hiding the numbers, no secret backroom deals. Everything needs to be out in the open. Third is fairness. You have to treat all shareholders, big or small, with the same level of respect. And finally, number 4 is responsibility. The company has to play by the rules, obey the law, and just be a good corporate citizen. When you have all 4 of those working together, you get a culture of integrity.
So, who's the referee here? Who actually makes sure these rules are being followed? Well, that brings us to the absolute heart of the system, the board of directors.
Now, the board isn't supposed to be in the weeds, managing the day-to-day stuff. Their job is to provide that crucial high-level oversight. They're the ones setting the company's long-term vision, giving the green light on huge financial decisions, hiring and, yes, firing the CEO and other top execs. Ultimately, their main job is to be the guardians of the shareholders' interests.
Okay, this is a really important distinction, so let's break it down. On one side, you have something called agency theory. It basically points out a problem. The people running the company, the managers, might want different things than the people who own it. Right? A CEO might want a huge bonus this year, while the owners want slow, steady growth for the next 20 years. That's the conflict. Corporate governance theory, on the other side, is the solution. It's the practical, structural framework, the committees, the reporting systems, designed to manage that conflict and get everyone working towards the same goal.
So, why do we care about all this? Is this just some academic exercise? Absolutely not, because good rules actually mean good business. Having a strong corporate constitution has a direct, measurable, and pretty powerful impact on a company's financial success.
I love this because it makes it so simple. You can think of a company's value using this basic formula. Good governance builds trust. More trust means investors see the company as less risky. And when you divide by a smaller risk number, what happens? The overall value of the company goes up. It's that direct.
And hey, the data totally backs this up. I mean, just look at the difference here. Companies with strong governance enjoy way higher investor confidence. It's really not complicated. People are just far more willing to invest their hard-earned money in a business they believe is transparent, accountable, and well-run.
So the bottom line is this, and it's a big one. Study after study has shown that well-governed companies aren't just safer investments. They actually perform better over the long term. They're better at avoiding those huge, costly scandals. They make smarter strategic moves. And at the end of the day, they create more sustainable wealth.
But here's the thing. This rulebook we've been talking about, it's not carved in stone. Corporate governance is a living, breathing concept, and it has to constantly adapt to meet the challenges of our modern world.
See, today, it's not enough to just look at the financial statements. A company's constitution now has to think about its environmental and social impact. That's the ESG you hear about all the time. Boards have to figure out how to navigate massive digital disruption. And they're moving beyond thinking only about shareholders to considering all stakeholders, their employees, their customers, and the communities they operate in. The whole definition of good governance is expanding every single day.
And you know, that really leaves us with this central question for governance today. In a world that moves at lightning speed and demands agility, where do you draw the line? Is this complex rulebook an essential safeguard that protects us and builds lasting value? Or can it sometimes become so bloated that it's just red tape that strangles innovation? Finding that perfect balance, well, that's the #1 challenge for the companies of tomorrow.